I want to start with the fundamental question of like, why does this even matter? That's where the short-term rental loophole comes into play. They'll try to track the actual GC time versus the sub time.
Every single last little detail that you can possibly think of. Let's get into it. All right, now the section you guys have all been waiting for, wanting to learn a little bit more about the STR tax loophole and what you have to do to participate in it and to qualify for it. But before we can actually get into that, we have to go through what is referred to as rep status or real estate professional status. So, Brandon, how do you want to go with this? How do you want to start it off? How do you want to explain it? How do you want to walk people through this one?
So I think the first thing that we should do is understand real estate professional status, because real estate professional status is the main exception to these rules that everyone wants to qualify for. And the short-term rental loophole, I think of it as like kind of like a real estate professional status on steroids. So maybe let's start there if that works for you.
Okay. Yeah, let's do that.
Okay. All right. So real estate professional status. Again, we're coming at this from the basis of we have a rental that after my rental income and my operating expenses and my depreciation are all factored in, I have a tax loss. And I understand that if I can't use the tax loss, it's not the end of the world. However, in order to fully optimize my taxes, I need to be able to use that tax loss. So to use the tax loss, there's a few exceptions to the rules, the passive activity loss rules. What we're going to talk about now is real estate professional status in short-term rental loophole. So if I can qualify as a real estate pro, in the last video, we talked about this $1,000 tax loss. If I can qualify as a real estate pro, I can use the $1,000 tax loss to offset my W-2 income or my business income. Or if my spouse can qualify as a real estate pro, the same holds true as long as we're filing a joint tax return. So to qualify as a real estate professional, I have to spend 750 hours working in real property trades or businesses. I also have to spend more time working in real property trades or businesses than I do anywhere else. So the 750-hour rule, that equates to about, I think it's like 15 hours a week. All right, so that's actually not that hard to achieve. But what trips everybody up is spending more time in real estate than anywhere else. So if I have a full-time W-2 job, if I'm working 2,000 hours a year, if I'm running my business full-time, which I do being an owner of a CPA firm, I'm putting in 2,000, 2,100, 2,200 hours a year, right? So if I'm going to qualify as a real estate pro, I have to spend an additional 2,000 hours in real estate. So I spend 2,000 hours running my CPA firm and an additional 2,001 hours in real estate, 80 hours a week. And the problem with that is, you know, I'm an optimist. And by the way, like when I built my firm, I started my firm back in 2015, 16. And it was an absolute grind for like 3 years, man. I mean, I kid you not, this is not an exaggeration. I would work 80 to 100 hours a week, every single week for 3 years. I skipped every Thanksgiving, every Christmas, every sick day. I worked right through it. The birth of my child took like half a day off, man, just cranked, right? Because sometimes that's what you have to do starting a business. And I just didn't know what I didn't know at the time that I do now.
Right.
But I say all that to say, I'm an optimist. I believe that you can work 80 to 100 hours a week for an extended period of time because I did it. But the problem is that the IRS will never believe you and the tax court will never believe you. Okay.
Fair
So
enough.
if you tell somebody, if you try to make the argument to the IRS or tax court that you worked 40 hours a week at your day job and an additional 40 hours a week in real estate, you will lose that battle every single time, literally every single time. There have been quite a few people that have tried. Every single person that has tried has lost. And we actually had 1 or 2 tax court cases in 2024 where people tried again and they still lost. So the problem with real estate professional status is that you have to spend more time in real estate than you do at your W-2 job. And that immediately blocks anybody with a full-time job running a business full-time from qualifying as a real estate pro. Now, your spouse could qualify if he or she stays at home with the kids and, you know, or they work a part-time job and they can spend this extra time and not have to exceed W-2 hours. But that's the main blocker with Real Estate Pro. And that's what opens us up to the short-term rental loophole as well.
So before we jump into the STR tax loophole, just want to kind of call out that from my understanding, what I've heard, a lot of people that do qualify for reps status, right? Tends to be the spouse, whether it be the male or the female, who is either taking care of the kids, but can still qualify for this status. Whereas the other person in the household is working full time. And that's where you see it more often than not, right?
Correct.
Okay.
Correct. Now, what's interesting, so the passive activity loss rules came into play in 1986, but real estate professional status was not actually added to the Internal Revenue Code until I think it was 1993 or 1994. And basically what was happening was real estate investors, people that were running real estate businesses. So think of like real estate agents, property managers, developers, flippers. They were running real estate businesses and then buying real estate on the side with their extra cash. And they couldn't use the real estate losses to offset their real estate business income. But the issue was that if you were a physician running a surgical center and you bought equipment for your surgical center, you could use the equipment to offset your surgical center income. And so that was essentially this level of unfairness that Congress evaluated and decided to add real estate professional into the code. And I say that to help people understand that real estate professional status is not like this like loophole, that people promote it as. And before the short-term rental loophole kind of caught momentum, everybody was promoting the real estate professional status loophole, but real estate professional status was designed for people that are working full-time in real estate. It was not designed for people that have a W-2 job or run a business that's not real estate related. So to further your point, you are correct. Like your spouse, that's typically the real estate pro. Like we've got a high income earner and we've got a spouse, and the high income earner they collectively funnel all of their income into their rental portfolio. Spouse manages rental portfolio generates losses that offset high income earners income, and we just create this big loop, infinite loop of tax savings building more wealth. That's the most typical situation. But if you are working in real estate full time, like if you're a real estate agent, a property manager for third parties, or yourself, builder, developer, all that type of stuff, then you can pretty much automatically qualify for real estate pro as long as you hit the 750-hour test and more time in real estate than anywhere else.
Very interesting. I actually appreciate the breakdown, because the breakdown is how I learn things better. So when I have an understanding of like why something exists and how they put it together and what was the logical reason behind it, it's like, oh, okay, I can see why this has been put together. So
well, what kicked us off on this entire journey was back in 2020. We like got big in the physician community, and so we had probably 20 physicians calling us every week, and we still do today. And I love physicians. My sisters are physicians, but what happens with physician communities specifically is there's a lot of competitiveness and there's a lot of FOMO. And so if one physician says, I'm doing this, I'm going to qualify as a real estate pro, all the physicians say, well, I am too. And so we had them all coming to us and we were like, look, like you can't, your spouse could, or, like you aren't married, so there's no chance. Right. And they didn't like it. And that's what originally led us to writing this huge real estate professional status guide, which is still on our website today. And it's like a 38-page ebook if you go download it. Yeah. But I got so tired of like trying to justify it that I just, okay, here's every tax court case. Here's every regulation. Here's every example. Here's how the IRS is going to audit you. Like, yeah. And so now we're just like, just go read that and then come back to us if you were, and that actually really helped that entire community. But again, through that process, that's where we found the short-term rental loophole.
That sounds so that's how you found the short-term rental loophole.
Yeah.
So and you said this in the first video, and I just want to clarify, and you just said it again now, where you found the loophole. Are you saying that you're one of the first people to like identify that this was something in the tax code that could be taken advantage of?
So if you like go back through Internet Archives, there's one website called Bradford Tax Institute that briefly wrote about it, and I don't know if it really like caught wind or really went anywhere. But when we were writing about real estate professional status, we realized, wait a second, there's this short-term rental loophole, and we had no idea if it was even legit. There's no real tax court cases on it. Bradford Tax had their one little write-up, so we were kind of reading about that, and we started talking to different professionals, and everybody's like, wait a second, yeah, this is kind of interesting. And so once we talked to one person who I'm not going to name, who I have a super high amount of respect for. He's like one of the most technically gifted accountants in the entire world, and I hope one day he comes and wants to work at my firm.
Nice.
But we talked to him, and we broke it all down. We went through all the regs. We went through everything. And at the end, we were like, collectively, hey, I think that this is actually something. At that point, that was like mid 2020, we started producing content on it. We did the podcast, we did webinars, we did blogs, we did everything on it.
Wow.
And that's when it blew up.
So you're kind of the godfather of this then, eh? I didn't even realize that till just now. So, I mean, there's no better person to actually be talking about all this 4 years later, right? Now where it's like I just see it in the general, like I go through my feed, it pops up,
Yeah.
everyone's kind of talking about it, and it's like you're the guy who kind of broke it down for everybody. So this is
Yeah,
probably
and there's nothing wrong with other people talking about it. Like
yeah,
we appreciate that because more word gets out and
yeah,
everybody's kind of optimizing, right? That's the idea. Help landlords across the country optimize their tax positions. But with everybody talking about it, there's also these like influencers on like
yeah,
TikTok that will sell you the vacation but not talk about the journey. And what you'll find if you stick around and continue listening to these videos, the journey is really important to win IRS audits.
yeah,
And if you don't nail the journey, you are toast in an
yeah.
IRS audit. So we'll get to that.
Yeah.
Yeah.
Just in case anyone doesn't know, Brandon's actually well known for calling out people on Twitter.
Yeah.
Which
Yeah.
makes sense now because like you're the one who went through all this work to figure it out. You kind of understand it inside and out. And so you see these other people talking about it and you're like, you're an idiot. You know what I mean? And like, what do you, I do that with
Well, it's
data.
also like, I mean, some of the people that I call out, we end up getting their clients for IRS audits, and then you go through all the journey, all the documentation, and you realize, wow, like they sold them on a blog post and didn't really go through any of the nuances. And so my goal, especially with this course, is to help you, listener, understand at least how to look at your tax return. If you're going to do this, at least how do you qualify? And then 2, how do you look at your tax return and ensure that your accountant is preparing it correctly? You would be shocked how many people mess it up. So we'll get to that, but
Beautiful.
That's the idea.
So this is that might be the best possible intro to actually now getting into the STR tax loophole, right? Now that we know that you're one of the people who helped figure it out, there's so many people who are screwing it up. Let's actually get into it. Let's talk about it. What are the details of it? How do you qualify? Every single last little detail that you could possibly think of. Let's get into it.
I want to start with the fundamental question of like, why does this even matter? This matters because there are a ton of people, there are a ton of high income earners that they're either single and they cannot possibly qualify as a real estate pro, or they are married but their spouse doesn't want to qualify as a real estate pro. I mean, it's one of the first things that we try to consult with new clients. It's like, because the typically the high income earner, male or female, will come in and drive the conversation and be like, I want to save a lot of money in taxes, and so I'm going to make my spouse qualify as a real estate pro. And they're like, well, let's get your spouse on the call and see if they're even interested, right? Like,
yeah.
And you'd be surprised. A lot of times the spouse is like, I don't want to do all this. So the problem is that real estate professional status is a blocker for anybody that's working a full-time job, because of you must spend more time in real estate than you're anywhere else, right? Yeah. So if you're working full-time running a business, you can't qualify as real estate pro. That's where the short-term rental loophole comes into play. There is a regulation, and I'm going to give you the actual citation. So it's Treasury Reg 1.469-1TE32A. I know, that's a lot, so I'll say it again. Treasury Reg 1.469-1TE32A. That Treasury Reg defines what is not a rental activity. And what is not a rental activity is any property that is rented for an average period of less than 7 days, less than or equal to 7 days, or any property that is rented for less than or equal to 30 days and significant personal services are provided to the tenants while they stay at your property, which is not most of our clients. It's maybe 2% of our clients that's them. Most of our clients running the short-term rental loophole are going to hit that first bullet point of less than or equal to 7 days. Now, what does this mean, right? Because again, the Treasury regulation says you do not have a rental activity if you have that average period of customer use of 7 days or less. So what that means is we have to look for the definition of rental activity, or where the definition of rental activity is used in Section 469, which Section 469 is the passive activity loss rules. These are the rules that were implemented in 1986. So when I say Section 469, that's what I mean. But when you go back to the basics of Section 469 and you look at the real estate professional status section, the specific wording says any rental activity is passive unless you qualify as a real estate pro. That's what that specific line item says in Section 469. So if you go to the regulations and the regulations say you don't actually have rental activity, if the average period of customer use is 7 days or less. And then I go back to section 469 and read it again. And this is what we did like 5 times with,
Yeah,
with the technical guy. We're like, wait a second, do we have something here? Because the actual wording is you do not, it says rental activities are passive unless you qualify as a real estate pro. But it's like, well, wait a second, I don't have a rental activity.
Right.
Because of the 7 days or less rule. So that means I don't have to qualify as a real estate pro.
Right.
So all of a sudden, real estate professional status goes out the window. And the beautiful thing about that is also with real estate professional status goes that test of spend more time in real estate than anywhere else, because that's real estate professional status specific. Okay. So now all of a sudden, if I'm a high income earner, single spouse that doesn't want to do real estate, I can still utilize my rental losses from short-term rental activities as long as the average period of customer use is 7 days or less. So it's like a really mind-bending or powerful shift of, okay, wait a second, as long as I skirt the definition of rental activity per the regs, which is that regulation that I read off to you, then I don't have to qualify as a real estate pro, because real estate professional status solely applies to rental activities.
That's such a clean way of understanding that, being able to understand like what is written over here, what is written over here, and what the differences are between that. Because when they say rental activities, naturally your brain goes to, well, an Airbnb is a rental, I'm renting it out, right? But it's like, well, it's the rental that they're referring to is actually more of a long-term rental, and you're actually running something more of a Airbnb, a hotel, right, which falls into like kind of a different category altogether. And so then therefore you don't fall within that category, you fall within a different category. Beautiful. Again, I appreciate you explaining these where it came from and how it all works, because it helps me understand it so much better.
Yeah, and just to even add on more authority to this, it was December 23rd, 2021. So it was about a year after we were like pumping all this content out. And I don't think that it was because of that. I actually don't know why they released this, but the Office of Chief Counsel released a CCA. So this is the IRS. They released a CCA. So if you were to type in CCA 2021 51005, that's CCA 2021 51005. That CCA essentially confirms everything that I just said. And specifically in that CCA, what they're analyzing is, should a short-term rental be on Schedule C or be on Schedule E? And so they go through a couple different examples. They go through the law and the analysis of the law, and their analysis is in line with our analysis. And they call out that specific regulation section, and they explain how it's an exception to the rules. So if you're like, because sometimes people like listen to it like, I don't believe that. Well, there you, especially accountants, by the way. So this is typically actually where we have the struggle, is accountants like, this is a lie, you guys are just making it all up. So when that CCA came out, we were like, bam, right there, baby, there it is.
That had to feel good, eh? Beautiful. Okay, cool. So tons of proof to back this up that exists, where it came from, how it originated. Where should we go from here?
So we can keep talking about like how the short-term rental loophole. So once you understand the 7 days or less idea, right? Yeah. We can talk a little bit about the timing. We can talk about the fact that you still have to materially participate in the short-term rental. Because sometimes people think, oh, well, I just have to buy a short-term rental. I can manage it really passively and then qualify. Yeah. There is still a qualification that you must hit. You don't have to hit real estate pro, but you still have to materially participate in the rental. So we can talk a little bit about that, and then maybe we could talk about Schedule E versus Schedule C.
Okay, so let's do that. Before we go any further, I just want to point this out in case anyone, because this took me a little bit to realize. And so if anyone else is in this situation where I want to clarify. The reason why the STR tax loophole is so intriguing is because you can write off your personal active income, your W-2 income, the income that you're getting from your job. You can write that off so that you don't have to pay those taxes. It is like one of the few ways that you can actually do that, right? And that's why it's so attractive, because most of these other ways that you can write things off all has to do with passive income and not active income. Am I correct with saying everything I just said?
100%. I'll give you I will repeat what you said in the CPA language.
Okay.
So if we go back to that example of I've got $10,000 of rental income, $7,000 of OPEX, $4,000 of depreciation, I have a $1,000 tax loss. If I can't qualify for an exception to the passive activity loss rules, the $1,000 tax loss is suspended on my tax returns. It's suspended on Form 8582. So it's a really great form that you should be tracking every single year, especially when you switch CPAs, because sometimes the new CPA just forgets to key it all in. So we've seen like literal hundreds of thousands of dollars of suspended losses just disappear. So always make sure you're tracking that. But again, that's Form 8582. So the $1,000 is suspended. But if I can qualify for an exception to the rules, primarily via real estate professional status, then I can use the $1,000 to offset my W-2 income, like you said. But if I don't have a rental activity, because this $10,000 of rental income was an actual short-term rental, then that $1,000 tax loss I can use without qualifying as a real estate pro, as long as I materially participate in the activity.
Beautiful. Now let's get into material participation.
All right, let's do it. So there's 7 tests for material participation. You must only meet one of the 7 tests. The 3 tests that our clients most often meet, real estate professional status or short-term rental, is substantially all, meaning that your time that you spend managing the property is substantially all the time that anyone spends managing the property. And what that really means is you self-manage and you're doing everything top to bottom, all the repairs yourself, improvements, tenant management. Nobody else is helping you. No cleaners, that type of thing. So if you can hit the substantially all test, in theory, you can do that with relatively few hours, right? Like if I work 50 hours on my short-term rental throughout the year, or my or whatever property throughout the year, and nobody else does anything, then it's my time of 50 hours divided by 50 total service hours. So it's 100%. That is substantially all the time, right? So I would have been materially participating in that example. So that's the first test. The second test is spend 100 hours in the activity and more than anyone else. That is the test that the vast majority, if not 90+% of people are going to hit with short-term rentals. Now, the problem with that test is that you have to show that you actually did spend more time than anyone else. It's 100 hours and more than anyone else. And so the only way to show that you spent more time than anyone else is to track everyone else's time, which can get complicated. But there's a tax court case that also came out in 2021 called Lucero versus Commissioner, where the taxpayer tried to argue that they spent 100 hours and more than anyone else. And there were a lot of problems with this taxpayer's time log, and we'll get into time logs here in a second. A lot of problems with the taxpayer's time log, but the tax court opined on it anyway. And they said, hey, even if we did accept your time log, you didn't show how much time anyone else spent on your property, so you still lose, right? So if you're going to hit 100 hours more than anyone else, you must show how much time everyone else spent. And that is a big issue that we're seeing right now with the audits where we are representing short-term rental investors. So then the third test for material participation is spend 500 hours and more than anyone else. And like I said, there's not more than anyone else, just 500 hours. Just 500 hours. You don't have to spend more than anyone else if you can hit 500 hours. 500 hours is just like this safe harbor threshold. Once you hit it, you're good. But those are the 3 tests that our clients typically meet. There are 7 total, but you only have to meet 1. And the way that you prove this to the IRS is you must record your time. So you have to have a time log, and you have to show on that time log when you visited the property, what property you visited, and how much time you spent, and specifically what did you do. And when I say specifically what did you do, I mean detailed notes, because these audits are coming 2-3 years later, and you don't want to be like a deer in the headlights when the agent asks you, what did you do on 10/8/2024? And you have no idea, right?
Right.
Or it says like I answered emails. Well, specifically what emails? What did you do? What you went shopping? Like we've seen big shopping trip as the description. Okay, specifically what did you buy? How is it impactful? Like leave a little bit of a narrative so that your future self can win an IRS audit. But you have to keep that time log in order to substantiate the substantially all test, the 100 hours and more than anyone else test, or the 500-hour test. If you materially participate, so if you have a short-term rental, you don't have to qualify as a real estate pro, right? which means you don't have to spend more time in real estate than anywhere else because that's a real estate pro test.
Yeah.
So if I have a short-term rental, don't have to worry about that. But I do still have to materially participate. I have to meet one of those 7 tests. So I have to have my rental has to have average period of customer use 7 days or less, and I have to meet one of those 7 tests. So if I can do both those things, that $1,000 tax loss from our previous example is unlocked, and I can use it to offset my W-2 income, even if I work full-time.
And just to confirm, this only matters in year 1 of the short-term rental.
It depends, right?
Okay.
It really depends. I would say most of the time, yes. And the reason being is that typically when we acquire the short-term rental, we are going to run a cost segregation study and accelerate the depreciation so that $1,000 tax loss is going to turn into an $80,000 tax loss.
Mm-hmm.
And yeah, we would really want to be able to use that $80,000 tax loss. So it's really important to make sure that we've got all of our ducks in a row. However, we've also seen situations where people don't accelerate depreciation the first year. You can always accelerate it later via a 3115. You file Form 3115. You make something called a 481A adjustment. That is expensive to do. It will cost you several thousands of dollars because it's extremely complicated. However, maybe in the year that I'm acquiring my rentals, I just don't have enough time, right, to do all of that. So I'm not going to do the cost seg. But maybe next year, I can create a lot more time to go and spend in the properties. And I'm just going to go manage this portfolio that I've already acquired, and then I'm going to hit the depreciation that year instead. So typically, yes, first year really important, but it's not a deal breaker.
Okay.
If you don't do it in the first year, you could time it for a future year.
Okay. I was typing up a question as you're asking that, and I was trying to understand, like, what are the advantages and disadvantages to, accelerating that in a different year? Because in my mind, the first thing I thought was, I got to, materially participate for not only the 1 year, but the second year and the third year. And it really, what you're saying is it's more of the year that you want to accelerate your cost segregation, where you're going to take those tax savings. That's when you want to be able to materially participate. Improve
Yes,
that.
sir. Yeah, you're like on advanced strategies here now. But yeah, that's exactly what you do. So
Okay.
so if it's this year that I want to get it, then I've got to materially participate this year. But if I'm just kind of building a little passively and then I'm learning about this, I'm like, wait a second, I could do this. We can do this in any year you want to. We'll look at people's tax returns and they'll have like a big liquidation event coming down the pipe, right? They'll have more income coming down the pipeline. Like sometimes there's an income event a few years away that will say, hey, instead of taking all this depreciation now, let's actually wait until that and then let's take it.
What would
And
be an
so it's just kind
example?
of this build.
Sorry, what would be an example of that, of like a big liquidation event happening down?
Yeah, so it could be a business liquidation. It could be like stock that you're getting granted. It could be that you are going to sell a rental in the future and you want losses to offset that gain without having to do a 1031 exchange.
Okay.
It could be that you're building your business and you expect to see some pretty significant growth over the next few years. And we might say, well, you got business income of $200K today, but you expect to have $1 million within 5 years. So let's like annual income. So let's just build the portfolio. And then when we start getting to the closer to the 7-figure mark, let's start spiking your tax return with losses at that point. But we'll have this big base of portfolio of cost basis that we've already embedded into your return to just hit. So that's where it gets a little strategic.
Yeah, that's very interesting because obviously we help people find properties, right? Like that is what our business does. Is if you need help finding a property, we do that. And we had a ton of people in Q3 that came to us wanting to find a property so they could take advantage of the STR tax loophole for 2024, right? Now we're in Q4 right now, right? It's October 8th, and we're telling everybody like, yeah, the ship has sailed. You know what I mean? Like you're not going to be able to get it for 2024 between the time it takes to find the property, go through the closing period, get it up and running, and actually host guests. There's not enough time. So you have missed it, right? With that being said, they could still get the property today and plan it out for 2025, right? It's like you missed it this year, but don't miss it next year, right? Or
100%.
Yeah, okay, cool. So there's definitely advantages there. One thing I just want to confirm, and I'm pretty sure I know the answer to this, but maybe somebody's thinking it. You can't take those losses backwards, right? So if I were to in 2025 get these losses, I can't write them off on my 2024 W-2 income that would have came through. Okay,
correct. Yeah,
cool.
And since we're talking about like forward and backward, because you also mentioned it with material participation, you can't carry hours forward and you can't carry hours backward. So Material participation, and when I say material participation, what I'm really talking about is that like 100 hours and more than anyone else tests. That's what I want everybody to think. So if I'm trying to hit 100 hours, I have to hit 100 hours within the calendar year that I'm going to spike with tax losses. So if it's 2024, I've got between now and the end of the year to book 100 hours managing this property. And we're going to get into the hours that count and don't count for your management, because a lot of people think, oh, if I just listen to this course, that's material participation, and I'm sad to say that it's not, right? But you just have to recognize that. So once December 31st comes and goes, next year you totally reset. But also there's some strategy with that too, if you think about it, right? Because sometimes people are like, well, I don't want to buy a short-term rental because then I have to self-manage it forever. That's not true. You only have to self-manage it for the year that you're going to spike with tax losses. So if it's 2024, you self-manage, you get the 100 hours more than anyone else, then you flip it out to a property manager January 1st of next year. Now you have a passive activity, and then you've opened yourself up to a whole nother set of potential strategies that I call passive activity netting, which is essentially like Rich Dad Poor Dad on steroids, which I don't think we need to necessarily jump into today, but it's a really cool thing when I can take my losses in 2024 and then flip my property out to a property manager, become totally passive. Now I've got passive income to offset with rental losses in the future too. So without having to jump through any hoops. So anyway, there's this whole whole back end strategy to it as well.
We'll create another mini course on the back end strategy. that'll be round 2. Okay, so we're kind of getting into the nitty gritty details of the STR tax loophole, which is obviously what this is for, right? Because people want to know these little pieces of information. We talked about material participation. We talked about accelerating your losses through a cost segregation study. Did we touch on Schedule E versus C? I don't think we did, right?
I don't think we did.
Okay.
So this is a really interesting one. Okay. I think a lot of accountants and even the IRS gets it wrong. This is always something that we have to address with the IRS agents whenever we are representing people in an audit for short-term rentals. So the issue is that that regulation section that I provided earlier, it was again 1.469-1TE32A. That section again says if your rental property has an average period of customer use of 7 days or less, you do not have a rental activity. Okay. People, accountants read that code section, and the IRS auditors read that code section, and they say, well, because you don't have a rental activity, that means that you should report this on Schedule C. And that is flawed analysis. And the reason that it's flawed is Section 469 solely deals with is an activity passive or non-passive. Section 469 does not determine where you report your rental on your tax forms. Okay. And further, Section 469, think of it as like its own island. This actually happens a lot in the Internal Revenue Code. There's a whole bunch of sections that are they're completely on their own, and you analyze them completely on their own, and they don't cross-reference to anything else. And that is Section 469. So Section 469 in this case is completely on its own. You analyze it solely for the purpose of, is this activity passive or non-passive? You don't analyze it in relation to anything else going on. It's not, can I deduct business expenses? That's Section 162. That's a completely different code section. Section 469 doesn't care about that code section, right? They don't care about your travel expenses. They don't care about where you report the property. All Section 469 cares about is passive or non-passive, okay? So when it says not a rental activity, the point that I'm trying to make is it's only not a rental activity for the purposes of determining, is it a passive activity or a non-passive activity? So for the material participation test, that's essentially all it's for. So this is the flawed analysis that accountants and that the agents make. The analysis that should actually be made is under Section 1402A, 1402A. Section 1402A is the section that defines the type of income subject to self-employment taxes. If you have income subject to self-employment taxes, that goes on Schedule C, because that's where you report self-employment income, right? If you don't have income subject to self-employment taxes, you find another form to report your income on. In the rental cases, you report it on Schedule E. So when we're trying to figure out Schedule C versus Schedule E, we totally disregard section 469 and we look solely at section 1402A. And when you look at section 1402A, the first thing that you'll see is rents from rental real estate are excluded from self-employment taxes. And then but it says unless you are a real estate dealer. So then we have to go and try to figure out what is a real estate dealer, and it gets pretty muddy pretty fast. But the general consensus is that if you are providing substantial services to your tenants while they stay at your property, you are a real estate dealer for the purposes of section 1402A, and you must now report on Schedule C. So who's doing these substantial services? Well, it's people that are like running a true B&B, right? I live on site. I cook the breakfasts. I cook the lunches. I cook the dinners. I'm touring my tenants around. I'm giving them all these amenities. I give them Uber credits, bus credits. Like I'm really going out of my way to make my tenants happy. I'm running a boutique hotel and it's an experience type of thing. If I have a beach rental and the only thing that I'm really doing is just communicating with my tenants and giving them a key code, and then I'm having my cleaner come in after the tenants leave to turn it for the next unit, that is not providing substantial services to my guests. That's not real estate dealer. So that's on Schedule E. So if I'm doing all this extra stuff, that's Schedule C. Now you're subject to self-employment taxes. But if I'm not, which is most of our clients, then it's Schedule E. And so the point that I'm trying to make here is that you just have to look at these completely separately. They don't cross-reference each other, and just don't get caught, because we see this happen a lot. Don't get caught with the flawed analysis of, well, if it's not a rental activity under section 469, then it must go on Schedule C. That's flawed analysis, because section 469 doesn't tell you where to put it. It just tells you if it's passive or non-passive, regardless of where it ends up on your tax return.
So that entire last section there was 100% for the CPAs. So if you are
well, and so if that like blew your mind, right?
Yeah.
Then what I would suggest that you do is go look up that CCA, that Chief Counsel Advice Memorandum that I previously stated, and I'll say it again. It's CCA 2021-51005. It came out December 23rd, 2021. You can Google that. If you type in CCA and then that number string, it'll come right up. And the reason when you read it, it's going to sound technical. It might blow your brain a little bit, but part of getting a good tax result is holding your team, your accountant, accountable to quality. And so you want to kind of familiarize yourself with this stuff and sort of like the nuances. You don't have to know the specific code sections. I know I threw out some code sections. The purpose there is to build your knowledge base so you could have more sophisticated conversations with your own accountants. You don't necessarily need to memorize this stuff. You don't need to like play a game of gotcha. But whenever you get whenever you're doing the consulting with them, or whenever you get your returns back, maybe you pull up this CCA and you kind of read through it just as a refresher, and it might spur some questions for your own accountant as well. So that's the purpose of sharing all that. It's just to help you have better conversations with your accountant.
Yeah, love that. Or just hire you, one or the other. So you have that option as well. So we've just gone through a lot of different things when it comes to the STR tax loophole. Is there anything that we missed that we want to cover before we hop over to the audit video?
So we talked about Schedule C versus Schedule E. We talked about the actual language that makes it a loophole. We talked about material participation. We didn't talk about the type of hours that count and don't count. You want to touch on that real quick?
Yeah, let's do that, because this is it's a nice long video. We're covering everything that matters specifically about the STR tax loophole. So let's put it in this video right now.
All right, yeah, let's do it. Hours that count and don't count. So this is where you have to be really, really, really careful as a buyer of tax services, because there are accountants that just will tell you what you want to hear to win your business. We are not that accountant. We will not tell you what you want to hear to win your business. We will tell you what you need to hear to win IRS audits. And I'm glad that we've always taken that stance, because over the past 10 months, IRS audits have like gone up 2,000 some percent, at least with what we have seen. So it's really important to make sure that you're protecting yourself and not just jumping into bed with somebody that's giving you something that you you want to hear versus what you need to
Yep.
hear. And education hours is part of that. So if you do any like amount of research, if you're listening to all this and you're like, okay, I'm going to go do some research on what counts and what doesn't count, you will see a wide variety of interpretation as to what types of hours count for material participation and what type of hours don't count. You'll see people say you can go on real estate cruises. You can go to big real estate conventions and networking events. You'll see that I can do all this research online and just wait, just really soft. I call them soft hours, like easy hours. And we tell you that doesn't count. And the reason that we tell you that doesn't count is because we've read every single tax court case related to Section 469, material participation, real estate professional status, and the short-term rental loophole. And the tax court says that stuff doesn't count. So the time that does not count is going to be any time that you spend on education and research. And I would say, with the exception of like if you are a real estate agent and you need your 20 hours of CPE to maintain your licensure, the 20 hours counts, right? So there are nuances to it, but they're pretty few and far between. So education and research time is not going to count. So I can't just go and sit on realtor.com and look for the next beach house for 10 hours a day. That doesn't count. Travel time to and from my rentals typically does not count. And I know that's a bummer. And it doesn't necessarily mean that it's not a business expense, just it's not going to count for material participation. It can count. There's a specific tax court case where it did count, and that's Lay versus Commissioner. But in the taxpayer, in that case, the taxpayer had a bunch of local rentals and was visiting them multiple times a week and self-managed them. And so the litmus test here is kind of, if I'm logging hours that don't really impact my property, then the hours don't count. But in this case, those hours spent traveling to and from the rentals, they did impact the property's operations because it was a weekly type thing. So it did count. The tax court did allow it. So there's a little bit of a nuance with travel. But if I've got my own beach home 2 hours away from where I live, travel time from my house to there doesn't count. Doesn't matter if I visit it 6 times a year or 12 times a year, it's not going to count. And then the last bucket of time that doesn't count is something called investor hours. So if you do not participate in the day-to-day activity, meaning you have a property manager, that's essentially what that means, right? So if I don't participate in the day-to-day activity, then my investor hours do not count. But if I do participate in the day-to-day activity, then my investor hours do count. So investor hours is like you could count them if you're self-managing, but you can't count them if you've got somebody else managing the day-to-day operations. Investor hours are time spent like researching, closing on the property, time spent doing my bookkeeping, reviewing financial statements, paying bills, talking to my CPA and my mortgage lender and my title attorney, preparing my tax return. And these are investor hours because these are things that literally any investor would do to make sure that their investment is performing. And so your investor hours do not count unless you are involved in the day-to-day operations, which effectively means you got to self-manage. So investor hours don't count unless you manage day-to-day. Education and research hours don't count, and then travel time is not going to count. Those are kind of the 3 main buckets of hours that do not count. But everything that does count is like what a property manager would do, right? Coordinating with tenants, communicating with them, leasing, setting prices, updating my VRBO and Airbnb listing with new pictures and new text and new copy, stuff like that.
Super interesting about the investor hours if you are actually managing or not managing, and like the differences between those, because it seems like you can get so many more hours on your calendar if you were to be self-managing because of all those additional things that you're going to have to do as an investor in that scenario. Very interesting. And most people likely will be self-managing in that year that they are trying to be able to take advantage of the STR tax loophole, because you almost have to, right? Unless you're, you got the property in January and you work the next 3 months on the property and then you hand it over to a property manager because you hit your 500 hours and you're kind of good to go at that point, right? 500 hours is 3 months worth of full-time work, pretty well,
yeah,
roughly around there, right?
Yep.
So the nuance, let's get into the nuances of this because I know there's going to be nuances that people are going to wonder. So first one being, if I am there to set up the property, does that count? It's not the operations, but I'm building the furniture.
So all that pre-work time can count if you do not have a property manager. And that's the big key, right? So people will always ask us, well, what about all the time that I spent like trying to procure insurance and working with my mortgage broker and my real estate agent, all that type of stuff. All of that time can count if you are not if you self-manage the property. But if you put a property manager on that, you're pretty much toast with all
What
that
if
time.
what if I'm
Even the
building the furniture?
yeah, so yeah, if you're building the furniture like that, that would be time that you could count regardless.
Okay.
Yeah.
So the setup period could easily take, maybe not easily take 100 hours, but depends on how much you're doing to the property. If there's a, what if I'm like repairing or blowing out the kitchen and putting a new kitchen in there? And maybe I'm not doing all of the work myself, but I've hired somebody to do the work and I'm kind of overseeing them while they're there. And I could just, would that all count as hours?
You could probably count some of it, but not all of it. So
Okay.
historically there are tax court cases where the owner being on site and watching contractors for hours and hours and hours at a time, that time's not going to count. You can't count the time just watching contractors. But if
Okay.
you're coordinating the crew and then you're, maybe you're bringing them materials, maybe you're doing an inspection after they're done, like that type of time can count. But sitting on the property with them while they do the work, that's not going to count.
So make this a little more complicated. Let's say I do have a GC that I'm working with, a general contractor, and they're overseeing the entire renovation that we're doing to the property, and they're overseeing like the setup of it, right? Maybe we're putting a pickleball court in, maybe we're doing a bunch of stuff to the backyard, things along those lines, right? And that guy alone is putting in a lot of time, right? Just overseeing all of the work and keeping track of everything that's going on. And maybe it takes, a month to be able to do all of that. And now he's just put in, what would that be, 160 hours, right? So does that now mean that I have to put in over 160 hours, and I also have to keep track of that guy's time that he's worked to prove that, yeah, he was here this entire time and his crew worked this many hours, each one of these guys worked this many hours, but then I personally worked 200 hours or 161 hours through all of these additional activities?
You have the understanding correct. Yes.
Okay.
You would have to track everybody's hours because it's 100. So what we're talking about now is material participation. And again, without material participation, that $1,000 tax loss is suspended and carried forward, right? So I want to materially participate, especially if I'm running a cost seg and I'm going to make that a much larger tax loss. To materially participate, you got to spend 100 hours and more than anyone else, but you have to track anyone else's time. And so, John, yeah, your question was if I've got a GC that's doing 160 hours, does that mean I have to do 161? And the answer is yes, 100%. You got to do 161.
So,
But I will say, just a real quick comment on
okay.
that. It is any other individual. So it's not like a company per se. It's not like my cleaning crew as a whole. It's technically each person on the cleaning crew.
That was actually going to lead me to my next question, which is I go to pay my GC, right? And I pay them $20,000 for all the work that they did to oversee the entire project. Now, obviously, they built a pickleball court, they built the fire pit area, they did some construction on the inside, but I just gave them a lump sum, and it took roughly a month to be able to complete everything. Now, I'm technically paying the company, not the owner, right? And there was a lot of other people doing things. So if I understand what you're saying correctly, I don't have to track each individual employee because I paid a company. Am I getting that wrong?
So you could do it either way. Technically, it says any other individual. Okay. So you want to spend 100 hours and more than any other individual. Now, if you track the company-wide activity, I don't think any IRS agent will want to disagree with you because that's going to put the IRS in a better position than it's going to put you, right? Because if I'm tracking the company that has 5 individuals that all spend time on my property, that's going to accumulate more time that I then have to exceed versus tracking each one of their individual participation in my activity. That's going to be more granular and it's going to put me in a better position with the whole hour test. So the point is like, you can kind of go either way. Like a lot of our clients just track cleaning crew.
Yeah.
All the cleaning crew. It doesn't matter like who's on the individual. But whenever they're doing like a repair or some major rehab or something, they'll try to track the actual GC time versus the sub time, so that they can prove like, no, I still spent more time than these individuals that worked on my property.
Okay. Yeah, because that's good to know for the GC and when the property is getting set up, and then where that same logic or scenario translates is to the cleaners and who, who's doing what as we go forward. I know when we talked about this last time, I had brought up the company Turno, which is, the company where you can find a cleaner to clean your home, and you can find another one the next day and the next day,
Yep.
technically in some of these markets, right? And so then therefore, if you found, let's say, one cleaner and that cleaner only worked 20 hours, and then once they finish working 20 hours, you popped in the next, or they work 99 hours, right? But they can't work 100. And then you just use Turno to find the next cleaner. That could be a way to track their hours more easily and make sure no one's working more hours than you.
Yeah, that's a great
That's an
way
option.
to do it. Yeah.
Or just tell your cleaning company, like, listen, I'm trying to do something. None of these cleaners can work longer than 100 hours. Therefore, you have to change it up when the time comes.
Yeah. Yeah, well, change it up when the time comes. That's the key statement, right? Because so part of what we try to balance at my firm, because I'm a business owner, I also own a bunch of real estate. I don't have a lot of time to play like tax shenanigan games, right?
Right. Yeah.
My partners at my CPA firm also own a bunch of real estate. The employees that we have at my CPA firm also own a bunch of real estate. So we're all investors ourselves, which is kind of an interesting thing that I didn't really plan on making happen,
Just
but
happens.
it just so happens that we end up attracting these tax and regular accountants that love real estate.
Yeah.
But it's cool because we can kind of talk investor to investor with clients. And this is one of the things that we'll actually talk about. It's like, look, you can go way out of your way and you can do all this stuff, but the reality of life is that there is a value on your time, right? And so we have to kind of figure out, how do we do this efficiently, and is it even worth it? And so that last point of, when it comes time to start making these switches, like, don't switch your cleaners up every single time. Run them multiple weekends in a row until their collective time gets like to 90, 95 hours. And then maybe think about switching them out with somebody else for the rest of but that's going to get you like, I mean, if you're really thinking about this, you got what, like 50 weekends? If you're really good at booking everything, which frankly, most of us more passive people are not very good at booking everything. So maybe 30 weekends, 30 times 3 hours, you're looking at 90 hours. So like, I never switch my cleaner because that's kind of how that works. So you should be aware that you have that option, but also we try to simplify it because, we're trying to do this without blowing up our own schedules and our own lives. So how do you kind of get that tax benefit without sinking a ton of time into your short-term rental?
That's the next level knowledge, right? Where people, they're like, oh, this all sounds great. And then they try to implement it and they're just running in circles, trying to make it work, trying to figure it out. And it's like, well, just don't complicate it so much. Do this, this, and this, right? So, and I'm sure there's a ton of other nuances and ways to be able to go through this. We're at 53 minutes just covering rep status and the STR tax loophole, which is what I expected to happen, right? Because there's so much information that comes along with this. Now we have one last section that we're going to go through, which is the audit section. So let's end this here, unless you have anything else that you want to cover. And maybe I'm jumping the gun. No, okay, we covered it all. So let's get into the audit section, which is, from my understanding, probably going to be one of the most important sections out of all of this, because we want to make sure we're following the rules so that you don't get audited and have to pay back those taxes, and you're kind of in a really, really, really bad situation. So let's hop over to that.